Professor Finley is back. A few weeks ago, the most powerful economist in the world sat in front of a Senate committee and said something nobody expected. He didn't promise lower rates. He didn't promise relief for borrowers. He talked about monetary discipline, about a balance sheet he called a relic of crisis-era thinking. His name is Kevin Warsh. He is the new chairman of the Federal Reserve. And right now, in the summer of 2026, he is sitting on the most consequential interest rate decision in years: cut or hold. It sounds like a technical detail. It is not. It is the difference between relief and reckoning for trillions of dollars of debt, stocks, and decisions made by ordinary people who have never heard the word FOMC in their life. Today, we break down what's actually happening and what the Austrian School of Economics would say about both paths. Let's start with the facts. As of June 2026, the Federal Reserve has held its benchmark interest rate steady at 3.50% to 3.75% for 4 consecutive meetings in a row. That's the rate banks charge each other for overnight loans. It sounds small, but it ripples through every mortgage, every business loan, every credit card in the country. This is the first set of meetings under new Fed Chair Kevin Warsh, who succeeded Jerome Powell in May. And here's what surprised almost everyone. The Fed's own projections now show 9 officials expect at least 1 rate hike before the year ends. Not a cut, a hike. Just months earlier, markets were confidently pricing in rate cuts for the second half of 2026. Bank of America has now pushed their forecast for the next cut all the way to July 2027. What changed? 2 words: sticky inflation. Inflation is currently running around 2.7%, above the Fed's 2% target, driven largely by energy prices that spiked after geopolitical tension in the Middle East. At the same time, the labor market is cooling, but not collapsing. This is exactly the kind of environment central bankers dread the most, and it's worth understanding why. The Federal Reserve operates under what's called a dual mandate, a legal requirement from Congress to pursue 2 goals simultaneously: maximum employment and stable prices. In normal times, these 2 goals point in the same direction. Cut rates, and you boost employment and growth at the cost of higher inflation. Raise rates, and you cool inflation at the cost of slower hiring and growth. The problem in 2026 is that both goals are demanding opposite actions at once. Inflation says, raise rates. The labor market says, cut them. Powell, before leaving office, called this the most difficult position he'd faced as chair. This is the scenario economists call stagflation, stagnant growth combined with persistent inflation. It's the same toxic combination that defined the 1970s, when the Fed under Arthur Burns tried to do both, support employment and fight inflation, and ended up failing at both for almost a decade. Now you understand why a single word, hike instead of cut, sent shockwaves through markets this June. To understand where this is heading, you need to understand the man making the decision. Kevin Warsh served as a Federal Reserve governor from 2006 to 2011, the youngest governor in Fed history at the time. He supported the emergency interventions during the 2008 financial crisis. But then he did something unusual for a central banker. He turned against his own institution. He became a vocal critic of the Fed's failure to unwind those emergency measures once the crisis had passed. He resigned in protest. His intellectual influences are Milton Friedman and George Shultz, both associated with monetary discipline and skepticism of central bank overreach. When Warsh was nominated in January 2026, gold dropped nearly 9% within hours. The market's read was simple. A hawkish Fed chair means tighter money, a stronger dollar, and less room for speculative excess. Warsh has talked about reducing the Fed's $6.5 trillion balance sheet, money created during years of quantitative easing, calling it a relic of crisis-era thinking. In his own confirmation hearings, Warsh stated plainly that inflation remains above target and more work is required to address it. This is, by Federal Reserve standards, remarkably blunt language. Let's walk through both paths, starting with a cut. If the Fed cuts rates, here's the immediate chain reaction. Borrowing becomes cheaper. Mortgages ease slightly. Businesses take out loans for expansion. Stock markets typically rally, because cheaper credit means companies can borrow to buy back shares, fund growth, and discount future earnings at a lower rate, which mathematically makes stocks worth more today. Government debt servicing also gets cheaper. And with U.S. federal debt approaching $39 trillion, that matters enormously. Every basis point the Fed cuts saves the Treasury real money on interest payments. Sounds good so far. Now here's the Austrian objection. A rate cut right now would not reflect actual market conditions, savings, real demand for credit, genuine risk assessment. It would reflect a political and institutional need to ease the burden of unsustainable debt and prop up asset prices that are already historically stretched, including, as we discussed in a previous video, the AI sector's enormous capital expenditure boom. Mises and Hayek would call this exactly what it is, artificially suppressing the price of money. And every time in history this has happened, 1920s America, 2008, the post-pandemic years, it inflated bubbles that eventually had to correct, often violently. A cut right now, with inflation still above target, risks repeating the late 1970s mistake. Easing too early, only to need far more aggressive tightening later. Now, the other path. If the Fed hikes, borrowing costs rise across the board. Mortgages get more expensive. Corporate debt, especially the hundreds of billions of dollars hyperscalers have borrowed to fund AI infrastructure, gets harder to service. Stock valuations, which are partly a function of how cheap money is, come under pressure. Markets generally don't like this news and react quickly. But here's the Austrian case for it. A higher rate is closer to what economists call the natural rate of interest, the rate that would emerge if the price of money were actually set by real savings and real investment demand, not by central bank decree. Higher rates force a kind of discipline. Businesses funding projects only viable because money was nearly free get tested. Malinvestment, the same phenomenon we covered in our AI bubble video, gets exposed faster, and the correction, while painful, happens sooner and is generally smaller than if it's delayed. Roland Baader, never one to soften a point, had a way of putting this kind of thing. He once compared central bank rate policy to a doctor who refuses to set a broken bone because the patient might cry. The pain doesn't disappear. It just waits and compounds until the limb can no longer be fixed without amputation. Baader would likely look at the current situation and say something like this. The Fed spent 15 years prescribing morphine for an economy with a structural problem, and now Warsh is the doctor who finally shows up holding a splint. And everyone in the waiting room is furious at him for it. There is, of course, a third path, and it's the one the Fed has chosen for 4 meetings running. Do nothing. Holding rates steady is often framed as the cautious, responsible choice. And there's truth to that. The Fed genuinely doesn't have clean data yet. Tariff effects, energy price shocks from geopolitical tension, and a cooling but not collapsing labor market all send mixed signals. But from an Austrian perspective, holding is not neutral. The current rate of 3.50% to 3.75% is itself a centrally planned number. There is no version of Fed policy that is doing nothing. Even inaction is an active decision to keep the price of money fixed by committee, rather than by market forces. Warsh himself seems aware of the tension. Analysts who follow him closely expect a couple of token rate cuts later in 2026, followed by a return to hawkish rhetoric once inflation data forces his hand. A pivot disguised as patience. So what should you actually watch for? If the Fed cuts in the coming months, watch asset prices, especially in tech and AI-related stocks. They'll likely rally short-term. But remember what we covered before. Cheap money doesn't fix structural overinvestment. It delays the reckoning and makes it larger. If the Fed hikes, expect short-term pain in markets, especially in companies carrying heavy debt loads. But also expect a faster, more honest repricing of which businesses and projects are actually viable without artificial support. Either way, the deeper issue Austrian economists point to doesn't go away. A committee of roughly 12 people is still setting the price of money for a $28 trillion economy. Whether they choose 3.5% or 4% or 3%, they are still guessing, using models, forecasts, and political pressure, at a number that, in a truly free market, would emerge from millions of independent decisions about saving and lending. Mises wrote that you cannot plan a price system from the top down and expect it to reflect reality. Interest rates are prices too. The price of time, the price of patience, the price of capital. Whatever Kevin Warsh decides in the coming months, cut, hold, or hike, he is still doing what every Fed chair before him has done, guessing at a number that markets, left alone, would discover on their own. Baader would probably put it more bluntly. He'd say we've built an entire economy around trusting 12 people in a room, more than we trust millions of people making their own choices, and then we act surprised when it keeps going wrong. The next FOMC meeting will give us the answer. But the real question was never cut or hold. It's whether anyone should be making this decision for the rest of us at all. If this made you think, like and share. See you next time.